back to reality. Maybe reality is, interest rates not being at zero anymore. I want to bring in our next guest and talk a little bit about M&A here on this Monday afternoon. Companies unveiled a flurry of M&A on what's likely to be the last major day for deal announcements in 2023. Ending the year on a high note after months of disappointing volumes. We spoke about a bunch of these with our TV team just now. Nippon Steel leading the way with $14 billion takeover of U.S. Steel. Clearlake Capital and Insight Partners confirming a Bloomberg News report that they've been taking data analytics from Alteryx private in a $4.4 billion deal. We saw some more private equity with Koch Industries, taking a $3.6 billion acquisition of an Iowa fertilizer business from a Dutch chemical firm. That became official. IBM bought $2.3 billion of data integration platforms from Germany's Software AG. Today was a really busy day, but something has fundamentally changed when it comes to these deals versus the deals that we've seen over the last decade or so. And that's none other than interest rates. Companies that relied on cheap credit to fund big mergers and acquisitions during the boom times now face a challenge. And that challenge is how to keep lofty M&A promises while servicing large debt loads in a new environment of higher rates and fading consumer demand. That challenge is the subject of today's Big Take, written by a trio of reporters, including our next guest, Nina Trentman. Nina is a senior editor at Bloomberg News, and she joins us here in the Bloomberg Interactive Brokers studio. Nina, good to have you with us this afternoon. Congratulations to you and the team on today's Big Take.
Thanks for having me.
Yeah, take us through the analysis that you did here, because you guys really dug through the data, you dug through the numbers to find how these M&A deals are faring in a higher rate environment.
Yeah. We went through company filings, bond indexes, and also rating firms reports for about 75% of 75 of the largest corporate acquisitions over the past 5 years. Of course, all done and struck during the time of low interest rates, when companies were able to borrow relatively cheaply, and were also making, as you said, lofty promises about synergies, debt reduction, and also the enhanced revenues that they would generate from these deals. As we found, looking at the deals, we found that the results are not as great as companies were hoping for, including that companies still hold a lot of debt. So less than half of companies have managed to cut leverage since the acquisitions. Almost a third of the companies have leverage ratios above 3.5 times, which is in many industries reasonably high. And then we also have average net debt to EBITDA levels of 2.7 times compared to 2.4 times, also indicating that leverage ratios are still high. And of course, now as companies are entering this period or have worked in this period of slower economic growth, financing costs rising, we're seeing that many of the deals are struggling. We mentioned a few in the story.
Yeah, I want to get to those in a minute.
Right.
First, though, I want to talk a little bit about the way the environment has changed just in the last month, or even in the last week, with Fed Chair Jay Powell coming out and, well, what he said and what markets interpreted perhaps are two different things, but the way that markets read into what he said in his press conference and what the dot plot showed us was that they're optimistic about rate cuts next year. Is that affecting the corporate borrowing rates of these companies that you talk about? I mean, shouldn't their rates be moving lower than they were, at least, in the last few months?
Well, many of the companies that we looked at for the story do have, because many of them are investment grade rated or were investment grade rated at the time when they did their deals, many of them did have fixed rate debt. So the fact that financing costs have changed doesn't necessarily impact the current financings that they have outstanding. That said, many of the companies, of course, that we saw in 2020 and in 21 tapping cheap financing will have to come to the market next year or the year after that. So if interest rates and financing costs were to move lower from here, then yes, they would see a benefit. Those that have floating rate debt will see an immediate advantage, but that's not necessarily always the case, given that investment grade companies usually like to lock in fixed rate debt.
So what are the implications of these companies coming out that have, leverage ratios of above 3.5% compared with 16 at the time of acquisitions, or net debt to earnings before interest, taxes, depreciation, and amortization at 2.7% compared with 2.4 previously? Where do we start to see the implications of that?
So important thing is, of course, so this is leverage ratios of 3.5 times and also 2.7 times.
Yeah.
So this is basically looking at the amount of leverage that they have versus the earnings that they generate. Interesting thing is what we also found in the story is that ratings firms so far have been pretty accommodating to these companies. So we've actually only seen a few cases where companies were downgraded. We've recently seen Walgreens, for example, that was cut to junk. But overall, and that's also one of the things that we found in the story, is this, that the companies could have seen ratings downgrades, but necessarily haven't yet. So it is one thing to see for next year and how far economic indicators change and in how far the performance of these companies either improves or declines, for ratings firms then to also potentially consider ratings cuts. For many of the companies that we looked at, actually ratings were not changed or very modestly changed.
And that would be a big deal if there was some sort of mass re-rating of these companies that are out there, especially if we see a decline in earnings.
Yeah, ratings for next year are expected to decline from current levels across the board, not just for companies that have seen, that have done deals. And of course, it will depend on the industry, it will depend on the individual company and what they've done, but there will probably be more focus from ratings firms to see if companies are performing the way that they would like them to.
Okay, so now let's get to some of the companies that you and the team did analysis on. What stuck out to you?
I think one thing was certainly this, that the combination of factors, including interest rates, economy, all those things sort of did have a dent for some of those companies that did deals, but then also there were deals where you just saw that there was strategic questions as to whether this is a deal that will work and is this a deal that will generate the returns for shareholders that the companies were hoping. So one of them was Walgreens that acquired Summit Health, a sort of healthcare services provider.
Yeah, New Yorkers will be very familiar with this one. City
because of the
MDs
City
are like,
MD
on every
brand.
corner.
Yeah, right.
Or at one point they were. I don't know if they still are.
Right. And so that's, I guess, one where there's not just the question around high leverage, but also the question as to, is this strategically a good move or not? Walgreens, of course, is now considering to potentially sell their UK arm Boots to bring down debt potentially with the returns. One of the deals we also looked at was Bayer Monsanto, where the company was A- rated at the time when they struck their deal. Now is BBB rated and has shelved a fair amount of its market cap and also its financial reserves because it keeps losing these Monsanto cases. So I guess those are all questions where sort of it's the financing environment is one thing, but then also the question, is this strategically a good deal or not, of course, comes much more to the forefront in these kind of times.
Right, which are two completely different questions at this point, but one of them hits harder at a time when there are questions about not just the U.S. economy, but the global economy as well. I was going to ask about, just in the last minute or so that we have, not every acquisition is a home run, regardless of the environment. In fact, oftentimes you look at acquisitions later in a publicly traded company, and it turns out that wasn't a good acquisition, regardless of the funding environment. How did you reconcile that with this analysis and the differences when, okay, well, it's not, these aren't always a home run?
Right. Of course, for that, the 5-year horizon that we took for the story is probably a little too short, given that for many deals, that companies aim to be accretive in the first few years after closing, but then sort of to see whether strategically a deal made sense or not, you probably want to look a little further than those 5 years. What I've been hearing from CFOs recently is certainly this, that in this more uncertain time and also in this time when financing costs are higher, given that the Fed hasn't really lowered rates yet, that they're saying, hey, the hurdle rates are higher.
I see.
So the thresholds that new deals will have to overcome will be higher, given that investors at a time of like also next year, the election, for example, will be more cautious.
Nina, it's a fantastic story. Nina Trentman is a senior editor at Bloomberg News. Check out her story on the Bloomberg Terminal, The Big Take on Bloomberg.